So, welcome back, friends. As I had mentioned in the early part of the week, on Monday itself, this would be a negative week for stocks. And we have seen the US stock markets pretty much go down quite sharply, except on Wednesday when we had the chip stocks like AMD and Nvidia rally quite a bit. So, the thing that one should note is that all this comes in the backdrop of Jay Powell, the Fed chairman, indicating on Wednesday that the Federal Reserve does consider a rate cut in its September meeting as being very much on the table, provided that inflation continues to behave the way it is expected to. In any event, even after such nice comments, or I would say dovish comments from the US Federal Reserve Chair, we have seen the Dow, S&P, Nasdaq tumble sharply yesterday, Thursday, and today as well. Today, a much weaker than anticipated jobs report for the month of July has reignited worries that the economy could be falling into a recession. As a result, we have the Dow Jones down 900 plus points, or a little more than 2%. The S&P 500 is dropped 2.5%, while the Nasdaq has lost 3%. It's down over 545 points at this point of time. Friday's sell-off has pushed the Nasdaq into correction territory. As you know that more than 10% from the all-time high does take a particular index into correction territory, and Nasdaq has entered into correction territory from its all-time high set nearly a month ago. The S&P 500 and the Dow were 6% and 4% respectively down from their all-time highs. Nasdaq 100, which is made up of the 100 largest names in the composite, deep in a correction, and they're trading 11% below its 52-week high. The July job growth in the US has slowed more than anticipated, while the unemployment rate has also risen sharply. The non-farm payroll grew by just 114,000 last month. The Labor Department has reported it is slowing from 179,000 jobs added in the month of June and below the 185,000 expected by economists polled by Dow Jones. The unemployment rate has increased to 4.3%. Amazon is leading the losses, sliding 12.5% after missing the street's estimates on the second quarter revenue and issuing a disappointing forecast. Quite interestingly, Amazon says that there are various distractions, such as those arising from the Paris Olympics and also from the about to take place the US presidential elections, which could keep a lid on the Amazon revenues and therefore its earnings as well. Well, whatever you can understand of the correlation, definitely to that extent you can understand why the Amazon's earnings miss can be interpreted the way it is meant to be. Stocks with the most to lose from a recession are also declining. So we have Bank of America losing 3% and Caterpillar stocks also lower. The 10-year Treasury yield has fallen to its lowest since February as investors flocked into bonds for safety. So we have the 10-year Treasury yield going around 3.85%. It was standing sharply higher at about 4.5% some time back, few weeks back. Friday's stock pullback would add to a steep sell-off from not only yesterday, but it has been a little bit concerned about the unwinding of the yen carry trade, which had raised the US indices to its all-time highs. And not only in the United States, but across the world, you saw index after index in India, in Hang Seng, the UK, all the indices were shooting through the roof and hitting all-time highs as the investors borrowed money in the cheaper currency, the Japanese yen, and invested in these high-yielding currency assets. Now that the Bank of Japan has intervened, and you find that the yen, which is recovering from its 30-year low vis-a-vis the US dollar, you find that the various carry trades are beginning to unwind. So the market is now wondering if the Fed is a little too late in transitioning the monetary policy, and that's the reason for this sudden fall today. the VIX, which tracks the 30-year implied volatility of the S&P 500, and it looks at prices of the options on the S&P 500 to track the level of fear on Wall Street, has also risen sharply higher. In the odds of this happening, there is, of course, the chances now which are getting priced in of a 50 basis points Fed Reserve cut in the September based on the interest rate futures prices. So we have that the odds of the Federal Reserve slashing its benchmark overnight lending rate a half a percentage point to 4.75 to 5% from the currently existing 5.25 to 5.5 at its next policy meeting in mid-September has soared on the Chicago Mercantile Exchange in reaction to July's weaker than anticipated jobs report. So traders in the 30-day Fed funds interest rate futures now assign a 61.5% chance of the central bank cutting borrowing rates by 50 basis points, up from only a 22% chance on Thursday. See what one day can make such a big difference. And we were right in predicting on Monday that all this is coming in sharp and furiously this week. 11.5% odds were there 1 week back, and a scant 5.5% probability was there 1 month back. So friends, conversely, you have the odds of only a quarter point reduction in the Fed funds rate in September has tumbled to 38.5% after the jobs report released Friday morning, from 78% on Thursday, 88.2% 1 week back, and 63.4% 1 month ago, according to the CME Fed Watch tool. By the Fed's last policy meeting of the year, on December 18, traders are now assigning a 44.4% probability that a Fed funds rate will stand a full percentage point below today's level at 4.25 to 4.50%. The odds that the Fed funds will fall all the way to 4.00 to 4.25% by the end of the year has suddenly jumped to 34.2% on Friday from just 2.6% on Thursday. Whether this is a knee-jerk reaction, whether there is going to be normalcy that may return in the stock markets next week, please do join our Prime or Prime Plus groups, which are addressed specifically at predictions, forecasts about the US stock markets, the Dow Jones, S&P 500, and the Nasdaq. And you can join these Telegram groups, which give you good forecasts about the markets, about the direction of the markets over the next few days, weeks, and months. And when the big fall, which we believe is beginning to work its way through the system, get ready for it. To people who are in our Telegram groups, you can join Prime or Prime Plus groups by WhatsApping us on 982-086-1044. Alternatively, you can also email us at globalmoneyinvestor@gmail.com. It is globalmoneyinvestor@gmail.com. Happy investing and enjoy the rest of the investing day. Take care. Bye-bye.